Folks, great to see many of you sitting down and those coming in. We are discussing a topic that has not been raised today. It has not been discussed in DC the past 3 months. It has not been discussed in international jurisdictions over the last several years. The topic today is on stablecoins. So again, thank you for everyone, especially for Congressman Goldman, taking your time out of a busy day to join us here. We really appreciate it. Let me just kind of zoom out a little bit. Why, from my perspective, right? Let's take a look about, what's alarming to you about the traditional payment systems that we're seeing, right? The current constructs, how can that be addressed by payment stablecoins, and really what makes payment stablecoins so compelling and worthy of their own regulatory regime, especially when you think about the fact that the US dollar already dominates the stablecoin market, right? And when you think about the primary use case for payment stablecoins currently is just for crypto transactions. So, Austin, do you want to start and we'll kind of roll down from there?
Yeah, sure. So to take the very TradFi case for that, one of the things that we still experience in the current system is that if you're just a normal two-legged person running a small to medium business, it's basically impossible to use the banking system without getting ripped off and taking credit risk to a bank. So like as an example, I have a friend who runs a grocery store chain, okay, not a big one. And if he banks at Silicon Valley Bank and they fail, he's definitely got more than $250,000 in there because people are buying like bread and tomatoes and butter, and that's his turnover. And by the way, margins are like 1%, so think of how much volume you have there. And I guarantee this dude's not a bank capital expert looking at these banks and being like, do I really know Silicon Valley Bank is safe? Like, I used to run a bank capital book at JP Morgan. I spent 100 hours a week on that, and I barely knew the answer to that question, if we're being honest. So one, I think we need to restructure the payment system because moving from 1970, when you barely used banks for payments, to today, we've inadvertently given a monopoly to banks on fractional reserve banking. Two, zooming out to your previous point, Jackson, we have a system that right now is very much a walled garden that functions like an oligopoly in the United States that is fragmented and not standardized. And one of the things we know about systems generically, like let's zoom out of stablecoins alone, is when you create an open access system that more people can plug into, you have greater competition, greater choice for consumers, and greater force of economic incentives. That is typically just strictly good, period, full stop. Like if we're mad about too big to fail banks, the last thing we want to be doing is inhibiting competition against too big to fail banks.
Yeah, I would just add onto that. Obviously, I don't need to tell this group the benefits of stablecoins, relative to other forms of payment, the speed, the transaction costs, the 24/7 nature of them. At Ripple, where I run the stablecoin business, Ripple's had a front row seat to how payments have evolved over the last 13 years, over 90 markets that we operate in. And we've taken a licensed approach, and I think we were talking about this earlier. One of the obstacles, if that was part of your question about the adoption, where I think the drumbeat is very loud, that stablecoins represent the killer app for payments. I think what's missing is there's still an education that needs to happen because stablecoins are often bundled together with meme coins and crypto and Silk Road, and there's just this, a lot of confusion. We talk to institutions day in, day out, and having to just get their heads wrapped around that a stablecoin is really just a form of a digital dollar, and that they walk and talk like a dollar, and if they're issued by a regulated, secure, well-funded, well-regulated entity, that you should have every faith and confidence in that. And it's about the least crypto type of crypto asset you can get. And so I do think stablecoin adoption will come, but it's more of an evolution, not a revolution.
So I would add, I think, two things. One, when I talk about stablecoins, and perhaps for my other panelists, we're talking about prudentially regulated stablecoins. Not all stablecoins are created equal at this point, I would say. And then second, I do think it's somewhat obvious about the need to innovate responsibly in the global payment space. What I would add to the conversation is, since 2008, there's a lack of trust of our centralized financial institutions. The next generation is digitally native, And they're distrustful if you have a payment, whether it's a grocery store or you're someone that's trying to live the American dream and you need to go to cash checking because your wire is going to take too long to clear or whatever the reason might be. So those digital natives or others that sort of lost the trust after 2008 have a problem why the financial institutions can use our funds for their proprietary means, and it takes a while and it costs a lot for those global payments and even the local ones.
Focusing a little bit more on the regulatory scheme that you asked about, Jackson. Yes, the vast majority of stablecoins are linked to the dollar, but we need to make sure that the issuers and the businesses are in America and are not going to other countries where they can feel more confident that there is a settled regulatory scheme. In addition to, I think, what Jack said, which is right, and you all understand, not speed, it's an equity issue. And to give access to people all over the world who may not even have bank accounts to the dollar and to an instantaneous transaction with very little friction cost will revolutionize the bank transfers, as you say, but also give a lot of people access to dollars, which will strengthen the dollar, make it more dominant. And I think that is the best, or one of the most powerful reasons, certainly, I push for stablecoin legislation. Is that it gives far greater access. So I do think we need to keep I'm happy Ripple's in my district, and we need to keep the growth and innovation here, even if other outside stablecoin issuers international stablecoin issuers are using the dollar.
So I've been focused on the broader financial technology space for the better part of the last 15 years, and I always joke around that way back when you launched a happy hour for fintech, you could get about 3 people to the bar, and now it's about 300 consultants and lawyers and that sort of thing. So times have changed in Washington, D.C., especially on the policy side. And one of the things I constantly hear over the years is the industry moving fast and breaking things, right? But the other thing I hear is, from the regulatory side of trying to put trying to really fit a square peg in a round hole, right? We've got 3 bills that have been introduced and kept me up late over the last 3 months: the Waters legislation, the Lummis-Gillibrand Genius Act, as well as the Stable Act. All 3, actually no, 2 of the 3 are going through continual revisions and changes. When you consider the proposed regulatory frameworks that are currently in play in the U.S., are we coming back to fitting a square peg in a round hole, or are things actually fitting correctly under these regimes? And more importantly, are we unintentionally straitjacketing the potential of U.S. payment stablecoin issuers through these regimes? So with that, Congressman, I will put you on the hot seat and then have the rest of you.
Well, I think these folks are probably better suited to answer some of the details and the real trickle-down effects of whatever the regulatory scheme is going to be, because from our vantage point, my vantage point at least, having the 1-to-1 ratio is very helpful right now to as this new industry is growing, and to have that stability, and to know, unlike traditional banks, that it's not going to be leveraged, and if you need to, there's no Silicon Valley Bank risk with that. So I mean, that's helpful, certainly, as we are thinking about the landscape of regulation. What I worry about, and this is true with stablecoin, but it's probably even more important in terms of market regulation, is that we make sure that we have as much of a bipartisan, pragmatic, practical framework now so that we don't get the whipsaw effect as new administrations or new Congresses come in. And certainly as I've spoken to many of the folks in this space, having those settled expectations is really, really important. And yes, it may mean more regulation than you might like, but I think that, at least as I look at it, the eliminating the cost of uncertainty and the whipsaw effect and making this more of a partisan issue, which does not help the industry, I think those are really important goals. And as I look at these bills, especially the Genius Act, it's a thoughtful bipartisan bill. I worry a little bit that this administration, which seems to view crypto as a grifting opportunity, is hurting the credibility of the industry writ large. Obviously, stablecoins could not be further from meme coins, but most people, most of my colleagues do not know that. And so I think one of the things that's very important for the industry is to be aggressive and robust about drawing those distinctions and emphasizing the real public policy value of stablecoin, especially because as an entry point into crypto, stablecoin is the most conservative, small c way, sort of vehicle for crypto. And I think just as getting our feet wet in it and in the space with regulation and legislation, that this is a very, very good place to start, and it's an important place to start.
Well, thank you, because Digital Chamber and that you're here to have this conversation, it's really important. I'm going to use a few buzzwords and then I'm going to get into specifics. So when I think of what's the right approach, I think of prudential regulation. So I get worried when I hear regulatory clarity. I don't think that the US system, if you look at lots of different ways in which we regulate, that we're always looking for clarity. Instead, we're looking for a really great balance so that you can have American ingenuity and you can have responsible innovation, which I would offer is a bipartisan issue to have responsible innovation. If you look at the stablecoin standard announced a framework, sort of a best practices framework last year. We did a bottom-up of all of the proposed and current stablecoin regulations throughout the world. And then we just did a comparison to the Genius Act. And I think what you'll see is that the Genius Act is pretty close to what other thoughtful regulators have done globally. And that, in and of itself, to me, I'm very optimistic about. I think the last thing I would say, which is like what worries me, having spent quite a while as a head of regulatory compliance in traditional finance before I joined blockchain around 2016, is this discussion about what is regulatory compliance, and that we are focused on BSA and AML. We're completely missing an opportunity. Regulatory compliance, if we want something that's sustainable, it's going to be able to be around and serve us well, whether it's quantum computing or whatever the next innovation is. We need to be more strategic. Conflicts of interest. All of these different things that are built into how we want to balance innovation and basically protecting our infrastructure in the right way, I feel like it's too myopic.
Lots to say on this topic. I think perspective, important to keep in mind, we're well ahead of where we thought we would be 2 years ago. And so I think that we should feel good about that. I think the other thing is that we're always mindful of driving for that optimal result. And I think perfection can often get in the way of progress. And so I do view this as an evolutionary of program. I think in certain instances, just to try to lend some different perspective, it's important to have an equal playing field across a number of fronts. And then there are other places where I think some specialization needs to occur so that we don't over-regulate. An example of that would be treating bank and non-bank issuers differently. You can't impose the same kind of restrictions on all entities when the entities are doing different things. Contrast that to where we need a level playing field, foreign issuers and U.S. issuers. There's been some proposed legislation that would essentially allow unlicensed foreign issuers into the market and allow them to have free rein to operate. And I think that that's something that really needs to be contemplated and understood what the intended and unintended consequences of that would be. We've been advocating for a state pathway with a hurdle that would then welcome a federal oversight through the OCC. It seems like most of the bills seem aligned on that front, which is terrific. We also view the need to have some minimum floor standards for state regulators. Otherwise, it would be a race to the bottom. We're regulated by New York. They're the toughest regulator in the land. We welcome that regulation. It's evolved over time. The level of transparency that we have with them is superb. And I think they've done a tremendous amount of really high quality work that would be a shame to let that go to the wayside. And so I think there is a path forward here for this dual sort of regulatory regime. And the last thing I would say is just keeping high the standards around transparency. The congressman, mentioned reserve management, where they're custodied, what sort of assets those are invested in, et cetera, all make a difference. And I think if you can incrementally establish certain levels of expectation, standardization, and transparency that then, as an issuer, we're examined against, I think the industry will be in a better place.
Yeah, to pick up the thread with New York, I've worked with the DFS quite a bit. We actually have 2 NYDFS regulated stablecoin issuers in the room between yourselves and GMO right here. So we can learn a few lessons. One is this. New York's been regulating stablecoins since 2018. How many NYDFS stablecoins have ever broken the peg or had problems with peg stability? Yeah, it's 0. Right, the cash side of this is actually a solved problem. We did money market reform after 2008. We know what products work. We know what products survive. I jokingly say to crypto people all the time, please stop reinventing the wheel on the finance side. I haven't seen anything in crypto that I haven't already seen a French quant blow up in the traditional system, okay? We know how this stuff works. On the other hand, stepping away to the bad side, part of the problem with the New York regime is they overdid it in terms of, in addition to regulating all of the things that we just talked about that are very good to regulate, they put some very stringent requirements on things like even needing 6 months waiting approval to issue on a new blockchain. And this hamstrings your ability to do business in the real world. The innovation is on the technological side, not on the finance side. We need a boring vanilla, we know how it works, financial box, and then technological innovation for the economy on top of it, because otherwise we're going to recreate the problems with the current system just using a slightly different ledger. We were talking about AML KYC before this panel, and I'll give the hot take here that I think blockchains are a significantly better tool to fight financial crime than the traditional fragmented system. But if we try to impose the exact same rules as though it works the same way, we're going to miss all of that. So I guess my closing comment on regulation is it's still very early. If the United States had been passing bills on the internet and in 1996 said, aha, email is solved, it's AOL, everybody use that forever, we'd all hate our lives right now. So let's also not make that mistake.
I got to talk to the person that created email, by the way. That's another one. Got a couple minutes left. One of the last questions here. We've got a lot of discussion around reserves, state pathway, federal pathway. Heard a lot about that over the last several months, and reciprocity in particular as well. What's not being discussed nearly enough, or what issue areas should be considered that are currently absent from today's debates, but that could present substantial opportunities or challenges to U.S.-based issuers or to compete internationally, or to ensuring U.S. leadership and influence in payment stablecoin policy globally? That was 8 questions in one question.
I've got one answer for you.
Good luck. Yeah.
Harmonization across the globe in terms of regulations, really tough to do. Not a lot of precedents to do it. I fully acknowledge that. But if you want to talk about unlocking stablecoins globally and truly realizing the potential of the exportation of the U.S. dollar, having regulators around the world agree to whatever standards are appropriate and how the money moves. We launched our stablecoin the end of December. We're ahead of plan. Everything's going great. That said, we're still locked out of the EEA, which we're in the process of getting a license for. There's other jurisdictions that are smaller but require licenses, and that's fine, and we're respectful of that, and we're going to go through the process. The challenge is getting the regulators, and I think that we've had lots of conversations with different regulators. There's a genuine interest in working together. I just don't know that we know how to do that yet. And just one simple example that's really challenging to solve for from a regulator standpoint is how you manage the reserves. And if you have a dual issuer model, we've got an issuer in the EEA and an issuer in the US, we both issue the same stable coin. The reserves, ultimately, you could imagine, all end up at BNY Mellon, Europe, US. It's one honeypot at the end of the day. Each respective regulator wants to make sure that there's enough reserves at any one point in time that any redeemer would be met. And because stable coins are passportless and they travel wherever, and we don't geotag them, we don't know where the stable coin ultimately goes, it's hard to manage for that. We've got ways around doing that, but getting the regulators comfortable that their ultimate citizens or residents will be able to redeem at any one point in time is a tough one to solve for. And so I think inroads into how different jurisdictions and regulators can work together to establish standards and workflows that will ultimately benefit the industry is something that is a big, big challenge. And I think if we're here 3-5 years from now, you're going to see some incremental progress on that.
Yeah, I would echo that in saying some of the proposals have terms for reciprocity, and certain jurisdictions like Singapore have done a pretty good job saying if you're issued here or in these countries that have commensurate regulations, it's a little bit easier to grow. So that is sort of the reciprocity issue hasn't been talked about, and I know we're almost out of time, so I'll just add one very briefly, which is there's a lot, and there's been a lot today about preventing theft and fraud, which is important. But I would say, particularly for your reserve issue, what we aren't talking about enough is the operational resiliency, the cybersecurity. So we're here in the vault room, right? Like if banks were not worried about their vaults and they were only worried about how people got in and out the front door with like checking IDs, they'd be missing the big systemic risk. So I think the operational resiliency, the cybersecurity risks are something that we should be talking more about.
Yeah, I'll hop in and say I think the other thing we're not discussing enough is what the long-term impact of getting this right is. Like Representative Goldman, you said this earlier, but I want to remind everybody, the only thing you need to get your hands on a US dollar stablecoin is the internet and something of value to trade for it. This is probably the first time in human history that any human on the earth who's got a smartphone or a computer can opt out of their local system and into the dollar system instead, in terms of both the currency and the legal norms of the United States. This is possibly the single largest expansion of human rights in history if we get it right, because every single regime that's done a poor job in terms of rule of law or expropriating people constantly with high inflation is going to get wiped out if we do this correctly.
I would, I focus much more in terms of risks and concerns on the non-stablecoin related crypto space, and certainly, as it has developed over the past couple of years, I think you've seen a pretty significant shift in the Democratic Party's view of crypto, and I was certainly a part of that when FIT 21 came to the floor. Just so you all understand, when there's an issue like this that has, and you may know this, but an issue like crypto, right, is specialized for the most part in two committees, the Agriculture Committee and the Financial Services Committee. If you're not on those committees, you're not dealing with it every day. And so what happened was it came to the floor, and a lot of us who were not on those committees started digging into it. And I am, as a former prosecutor who did securities fraud prosecution, have some understanding of the SEC, of the CFTC, of what the KYC and AML and Bank Secrecy Act requirements are. And I looked at this and I said, this is insane to put all of these restrictions and these disclosure requirements that you would for a security on any transaction that would not otherwise be a security, and that of course will kill the whole industry. And I think that it was helpful for us to have that vote, even if ultimately we didn't get the bill all the way through. But then when you look at also how there was essentially enforcement by litigation, that uncertainty is really, really problematic. And so what I hope for, and I'll sort of take a step, both with stablecoin, but more broadly, is that as Austin said, I think we have to figure out a regime that not only works today, but that can innovate and grow. I think a lot about Section 230 in this context, which in 1996 made a lot of sense. Today, we're not that worried about whether Google and Meta have, and Twitter or X have liability safeguards. They're the largest companies in the world. And so what we don't want to do right now is, in order to get something through, be short-sighted. And we don't want to be penny-wise, pound-foolish. So there's a balance here, and Beth pointed it out, I think, very well, which is you have to protect the consumer, and you have to make sure you're protecting the system in the whole. But we also have to allow for innovation. And what's hard is it's hard to predict where this is going to go. And what I will say, just from my vantage point, is two things I think are very important for you all to be thinking about. What's the next generation? What's the thing that's going to come, and what might be an obstacle, but also advocating for practical, pragmatic, bipartisan legislation, which will provide a lot more certainty to the industry, will maintain the bipartisanship that is growing in this space, and ultimately will allow the legitimate companies to grow and innovate and build, and it will weed out the bad apples, which is also very important, and which I think every legitimate company wants to do as well. And so, from an industry standpoint, as you are all here, advocating for regulation is a credibility builder, and certainly, something that I have taken to heart that matters to me. That, all right, this is not an industry that is looking for, looking to perpetuate Trump coin over and over and over. There are thoughtful people looking for settled expectations.
Congressman, with that, thank you very much. Thank you for your time. To the rest of the panelists, ladies and gentlemen, please, a round of applause. Thank you.